It wasn't a failure of diplomatic channels. It wasn't a miscalculation of naval strategy. It wasn't even a breakdown in high-level trade negotiations. It was the physical seizure of the input required for modern civilization. The pattern is unmistakable. Empires do not die from a single battle. They die when they lose control of critical resources that sustain their complexity. For 2 centuries, the West has assumed that capital controls resources, that if you print the currency, the minerals will flow. The arithmetic is merciless. That assumption is expiring. China now controls the vast majority of global silver processing. Current data suggest this figure sits between 60 and 70%. This is not about jewelry. This is not about silverware. This is about the conductive metal necessary for every solar panel, every electric vehicle, and every guided missile in the U.S. arsenal. The restriction has begun. The leverage has shifted. The paper price on the Quamax is becoming a fiction. The physical reality is asserting itself. History provides a roadmap for what happens next. When a hegemon loses the ability to source its essential inputs, the economy hollows out. The currency loses its utility. The social fabric tears under the weight of scarcity. The mechanism is not new. It has happened before. We can trace this exact sequence through 3 specific historical epochs. The names change, the technology evolves, but the constraints of physics and economics remain absolute. Consider the Roman Empire in the 1st century AD. Rome's dominance was built on the silver denarius. It was the standard by which all Mediterranean trade was settled. But by the reign of Emperor Nero in 64 AD, the silver mines in Spain were becoming harder to exploit. The physical supply could not keep pace with the empire's spending. The costs of maintaining the legions and the bureaucracy were unsustainable. Nero chose the monetary shortcut. He reduced the silver purity of the coin. He debased the currency to pay the bills. The resulting inflation was not immediate, but it was inevitable. By the crisis of the 3rd century, the currency had collapsed entirely. Soldiers demanded payment in physical goods, not worthless coins. The middle class was wiped out. Land became the only store of value. The social contract fractured because the state lost control of the metal that underwrote its power. Just like Rome, the Spanish Empire in the 16th century faced a crisis of silver, though from the opposite direction. Following the discovery of the Potosi mines in 1545, Spain controlled the world's silver supply. They had the ultimate leverage, but they made a fatal error in economic structuring. They used the silver to buy finished goods from abroad. Rather than building domestic industry, they outsourced their production capacity to the Netherlands, England, and France. The influx of silver caused the price revolution. Costs soared. The Spanish middle class was priced out of their own economy. The empire became a hollow shell, rich in money, poor in capacity. When the silver flows slowed and the wars became too expensive, the economy collapsed. Flight into land and titles accelerated. Spain defaulted on its debt multiple times, proving that possession of the resource is useless without the industrial base to utilize it. Just like Spain, the British Empire in the 20th century discovered the pain of losing resource dominance. By 1956, during the Suez Crisis, Britain was technically a victor of the Second World War, but financially it was broken. It had lost control over the raw materials of its colonies. The pound sterling was under immense pressure. The United States threatened to sell off its sterling reserves if Britain did not back down in Egypt. Britain had the navy, but it did not have the gold or the oil independence to act unilaterally. The result was a chaotic devaluation. The 1960s and 70s saw the UK plagued by inflation and the English disease of stagnation. Investors fled the pound for real assets. The middle class saw their savings evaporate in real terms. The empire didn't end with a bang, but with a restriction of credit and a loss of resource access. The pattern repeats in 7 distinct stages. Stage 1. The empire achieves peak dominance, controlling both the currency and the resource supply chains. Stage 2. The costs of maintaining the empire and domestic entitlements become unsustainable. Stage 3. The empire chooses a monetary shortcut, printing currency or suppressing prices to mask the deficit. Stage 4. Physical reality asserts itself. The dominant power loses control of the critical resource inputs. Stage 5. Inflation rises as the currency chases fewer accessible goods. Stage 6. Capital flees into hard assets, pricing out the working and middle classes. Stage 7. Social fracture occurs, leading to a total restructuring of the economic order. We are watching Stage 4 transition into Stage 5 in real time. The United States has spent decades financializing its economy, much like Spain, while outsourcing the dirty work of refining and processing to China. The assumption was that the dollar would always buy the silver, but current data suggests China is now restricting exports of critical minerals, including the processed silver required for the green energy transition. The incentive is clear. Why sell the raw material to a rival when you can dominate the manufacturing of the final product? The arithmetic is merciless. The U.S. plans to expand solar capacity and defense production require more silver than is currently available in the free market. China controls the bottleneck. Some observers argue that the U.S. can simply open new mines or source silver from Mexico and Peru. This interpretation ignores the bottleneck of refining. Mining the ore is only the first step. Turning that ore into industrial-grade purity requires energy-intensive processing facilities that the West has largely dismantled. Due to environmental regulations and labor costs, rebuilding that capacity takes a decade. The restriction is happening now. Under these constraints, the rational move for the dominant supplier is to squeeze the dependent consumer. The trajectory leads to 3 potential endgames. The first is a controlled decline. In this scenario, the West accepts a lower standard of living and high inflation while frantically trying to reshore industry. This mirrors the British experience of the 1970s, painful, gray, and diminished. The second scenario is a chaotic collapse. Supply chains freeze, factories idle due to lack of silver. The defense industrial base falters. This resembles the late Roman crisis, where the complexity of the system simply cannot be maintained. The third scenario is a reset and restructure. This involves a return to a resource-backed monetary system, where the price of silver is revalued significantly higher to incentivize production, effectively wiping out the debt in real terms. We saw a version of this in the 1930s with gold. The only variable is timing and pain. Subscribe to the channel. Focus on understanding the supply chain. Build resilience in your own skills and resources. Ignore the noise of the paper price. Watch the physical flows.